another way to use the moving averages. Now let us understand the last way, or the fourth important way we want to discuss the usage of a moving average. That is moving average crossover. Now, as we said that the shorter term moving averages are relatively more sensitive to the longer term compared to the longer term moving averages. So if we are looking at a 5-minute moving average, it will follow the price more sensitively than a 20-day moving average. So if we see that the medium or longer term moving averages are already in the upward direction, slanting or sloping upward, and we see a positive crossover like shorter term moving average 5 period going above 20 period, then this is called a positive crossover. Here we can see the red line, the thin red line indicates the shorter term moving average, that is the 5 period moving average, and the blue line here is indicating the 20 period moving average. What we are saying that as and when the shorter term moving average goes above the medium term moving average, that is 20 period moving average, and from the slopes we can understand that it is an upward trending move, we can see there are beautiful up moves that is following. This is 200-300 point of rally in the case of Nifty, and these are happening quite frequently, and these are quite good tradable moves. Now a 520 crossover would happen in a positive direction, providing a long opportunity in an upward trending move. Similarly, suppose we are looking in a downward trending move, here we can see that all the moving averages were above the price, so it was a relatively bearish market, and the 5 moving average crossing the 20 moving average, that is the, let me hide the all other moving average, then we will better understand this part. So I'm hiding all the moving averages except 5 and 20 so that we can understand this part. So here we come. See, as we can see that the medium term moving average, let me have this 200, and just as it was turning down, so whenever the price moved, the 5 period moving average moved below the 20 period, there were good shorting opportunity, and as the 50 period moving average was slanting upward direction, whenever there was a positive crossover, this was giving a good trading opportunity. Now let us look at a 20-50 kind of a crossover. 20-50 kind of crossover, we normally look at 100 period moving average as it is sloping upwards, and if we can see that such crossovers are happening, like here it touched the 50 period moving average, the 20 period, and as it went up, we can see that the price went quite higher. So all these positive crossovers when the uptrend is going on are well tradable opportunity, and in the downward direction the opposite. Now one thing you should understand, as 520 these kind of moving averages are more sensitive, they will happen relatively more frequently, and they will provide early entry points. Now if we are looking at all the moving averages together, let me look at here, we will find that like a 20-50 crossover or 50-100 kind of crossover that happened even later. See, here there was a downtrend and then an uptrend started. Now as we can see in this chart here that the 520 crossover happened somewhere like here. The thin red line is the 5 period moving average, and this blue line is the 20 period moving average. Now this happened pretty earlier. Now this thin blue line is 20 period, and this 50 line, this saffron line or the orange line, this thick orange line is 50 period, and this blue line is 20 period. See, this 520 crossover happened pretty earlier, this 20-50 crossover happened pretty later, and this green line, thick green line is 100 period. This 50-100 crossover happened even later. Let me plot 200 here. The 100-200 crossover happened somewhere even later. So basically, when we are looking at shorter period moving average crossover, they give early buying signals and they can reverse also. But when we are looking at a longer period moving average crossover, like 50 crossing 100 or 50 crossing 200, in a trending market, they will happen once in a while. And once that happens, we can understand we are in the midst of a very large longer term trend, because this kind of crossover in a trending market doesn't happen very frequently. If we can go back in days and go back in few years, suppose we are looking at in the phase of 2008 and 10, in those kind of days we will find that here we are again in 2016. So let us move a little bit faster in the backward direction. So if we go back a little bit in terms of time, here we can find that the moving averages are all crossing each other very frequently, because this is a choppy market. And as we said, that medium term moving averages are in the horizontal form, or they are in horizontal, so there is no trend. But if medium term moving averages are slanting upward or downward, then we are in a trend. In that case, positive crossovers of medium term moving averages become very significant for entry of longer term trades. Now, as we have known about the simple moving averages, I would like to introduce you to other form of moving averages. Here we are looking at the Tech Mahindra daily chart. Here the 50 period moving average is represented in red mark. This is the simple moving average. This is the line that is below, and then there is the 50 period exponential moving average that is represented in the pink line, that is in between, and the weighted moving average that is plotted in blue line. Now, what are this weighted moving average and exponential moving average? A simple moving average gives equal importance to all the data points. For last 20 days, if we are calculating, or 50 days we are calculating, all points are given equal weightage. Now, an exponential moving average, which is the middle line, the pink line, that is giving a little bit more importance to near-term data than the old data or the furthest data. So, this becomes a little more sensitive to the price movement. See, the red line is the most lagging, the pink line is the next after that, because it is giving a little bit more importance to the price movement. And as price is going higher, the pink line moves faster in the higher direction than the red line. Now here comes the blue line, which is weighted moving average. The weighted moving average gives much more importance, or much more importance to the near term data, and that's why it is the fastest reacting moving average. Now, which one you use in your analysis or trading, that depends on you. If you are looking for a very longer term trade entry, you can actually look for a simple moving average. But if you want to enter quite fast or early, then you should look at a weighted moving average. But if you are in between, you can go for exponential moving average. Each one has its own power of deciding how you make profit, but the factor is that weighted moving average, once we look at it, would be giving much more entry points, and some of them may be false also. Here we are looking at 50 period. See, now we can see the difference. Suppose we are looking at a 10 period. Let me make 10 in each and every case here. We will understand them. So once we make a shorter term moving average, we can see all of them are following almost in tandem. Still, if we are looking at the chart, here we could find that the weighted moving average, that is the blue line, is moving a little bit faster compared to the red one, which is the simple moving average, which is the slowest one, and intermediate is the exponential moving average, which is represented with the pink line. So this is all about moving averages that we wanted to discuss. Choose whichever you like and whichever fits into your trading schemes. One more point, as we are discussing, here we have looked at daily chart. We can plot similarly moving averages for hourly or 15-minute charts also. So whatever time frame you want to trade, you can use moving averages in those kind of time frame charts because they work in all conditions. So thank you very much for watching the video.